Hey, Steve Saretsky here. As always, the Friday recap video on Canadian real estate, basically everything you need to know with a focus on Vancouver real estate. Good to be back here in the saddle. Missed last week, I was away in Mexico on vacation, so I'm going to bring you a good video here today. If you haven't already, like these videos, subscribe, thumbs up, I appreciate it. There's going to be a blog post that goes with this in the description below, basically recapping, highlighting everything that you need to know on the mortgage stress test, which is what I'm going to be talking about today. I want to hear your comment in the comments below. I'm going to answer any of your questions, and I want to hear your feedback, what you think of the stress test, etc. And so basically, I'm going to get into it. I'm going to try to keep this as brief as possible. I'm going to talk about sort of what they've implemented, the workarounds, and the implications on the market. And then, of course, I want to quickly touch on the implications of that on the pre-sale condo market. So stick with me here. So basically, in November of 2016, OSFI brought in a stress test on insured mortgages. So if you're putting down less than 20%, you're going to get stress tested then at the overnight rate of 4.64%. Okay, so what happened was all these people that were desperate to get into the market, trying to get a mortgage, you know, prices are going up, you need to take on a bigger mortgage so you can get the home that you want. They basically had to get creative and avoid this stress test so they could borrow the amount that they needed. So you had people basically taking more money from, say, mom and dad, getting alternative lenders to come help you out, mortgage bundling, and they were basically getting creative and they were avoiding the stress test, and they're getting up to the 20%, whatever, various workarounds. And so what we saw in the numbers, and this is what OSFI basically came out and said, is there was a huge jump in uninsured mortgages and a drop-off in insured mortgages. So as of August 2017, the official numbers are uninsured mortgages, i.e. 20% down or more, went up 17% year over year, and insured mortgages dropped by about 5%. So that was all the people that were basically avoiding that stress test. So OSFI has come in, they've banned mortgage bundling now. They're saying no more of that. So what that was is basically alternative lenders like Home Capital Group, Equitable Group. Now this is about 10% of Equitable Group's business. What they were doing is, in simpler terms, it was giving you one loan and registering a second mortgage giving you a second mortgage to basically skirt the stress test. And so they're saying no more of that, no more mortgage bundling. And now we're bringing in a stress test on uninsured mortgages. So what that is basically it's your approval mortgage rate. It's either or the greater of the overnight rate. So let me break this down for you. The overnight rate now is 4.89%, or 2% on top of your approval rate. So basically, again, simpler terms, let's say you're a borrower, you're going in for a mortgage, you go into RBC, you say, I want to lock in a 5-year fixed mortgage because I'm going to go buy a home. I got 20% down here. They're going to say, okay, great. Your mortgage, we're going to give you a 5-year fixed at about 3.2%. That's what it is today. And now you have to get stress tested at 5.2%, so 2% on top of whatever your mortgage rate is. So you're getting stress tested at 5.2%, even though you're borrowing the money at 3.2%. So basically, I'll give you a very simple example. This is from my mortgage broker. Your typical person, he's given this an example, and it's a very typical one. Someone's making $78,000 income. They have no debts. They got a good credit. Typical property. Here's the strata fee, taxes, etc. You would get a loan before the stress test. You would get a mortgage of about $500,000 based on the $78,000 income. After the stress test, now your loan is going to go from $500,000 down to $400,000. And even though you have the same income, same everything, because of that stress test, you're only going to get a mortgage for $400,000 now versus the $500,000. So you had a 20% reduction in your mortgage in what you're able to borrow. So what that basically does is it pushes you down that property rung. So maybe you know, you could have afforded, say, a $600,000 condo. Now you can only afford a $500,000 condo. So it basically brings you down. And so you can see sort of the implications there. Now, to quickly bring in someone who's, you know, talking about certain loopholes. Now, understand that credit unions, which is like Van City, Coast Capital, they are not subject to OSFI stress test because they are not federally regulated, they're provincially regulated. But so everyone's saying, well, why wouldn't you just go to a credit union and get a mortgage, then you don't have to get stress tested? The thing is, these guys don't have the same capital as the big banks. They don't have as much money as RBC, CIBC, TD. They don't have that kind of money. They don't have that kind of funding. They don't have that kind of depositors, access to the outside investment world, etc. So these guys are basically trying to pull in and mitigate their risk. They only have so much capital to lend out, so they can only take on so much more additional volume. So everyone that thinks they're just gonna go away from the big banks and come into the credit unions, this is not gonna happen. So basically, I'll give you one more example. I had a mortgage underwriter friend that works at one of these credit unions, and in 2016, they hit their year quota. They hit their quota for all of mortgages of 2016. They hit their quota in April. It took them 4 months. That's how much like volume that was coming into them. And so by June of that year, they said they cut off their mortgage broker channel and said, that's it. We're not gonna do any more of those mortgages, those loans where we have too much volume coming in. And they're basically saying, oh, we're only gonna give mortgages to existing customers of our bank. That's an example of these credit unions. They're trying to pull back, mitigate some of their risk, mitigate some of their exposure to the market. They only have so much capital to lend out. Right now, they're very backed up. They hate subject-free offers. They have very, very limited capacity. It's the same thing with alternative lenders. I've talked to a lot of these guys. They're trying to raise capital right now, but we've had a crazy market for the last 2 years. They've loaned out a lot of their money. These guys don't have an endless amount of money. They don't have the kind of funding that these big banks have. So, you know, where does this all lead us to? Basically, is you have about a 20% reduction, whether you're going insured or uninsured. You're reducing everyone's borrowing capacity. You're slowing mortgage credit growth. And again, if you've watched a lot of my videos, a good economist who talks on this is Professor Steve King. But mortgage credit growth is a function of demand. So obviously when your income stays flat and house prices are going up, how do you afford a home? You need a bigger mortgage. You need access to credit to basically support higher prices. In order to support a higher and higher and higher price, you need more and more mortgage credit growth to continue, and you need access to that credit growth. So when you take away a 20% reduction of someone's borrowing capacity, you're reducing the average mortgage by 20%. That is a function of demand. You're basically reducing demand. And so I don't know what's going to happen to prices. Okay, I'm not going to make some sort of prediction and say that prices are going to drop by 10% in the next 5 months on the particular date at a certain hour of the day. But I have a hard time believing that by reducing mortgages by 20%, by reducing the typical mortgage by 20%, I have a hard time believing that that's going to increase prices. I don't think, you know, when we have condo prices going up to, 2% every month, do I think that by reducing your mortgage by 20% that's going to push prices higher? I have a hard time believing that. I think that what it'll do is it'll slow growth. Not to say that prices are going to come down, but it will certainly slow the acceleration of the prices. I think that this could ultimately have certainly an impact on subject-free offers. I think that, now coming in subject-free, no financing, even though you need financing, is extremely, puts you in a very vulnerable position with these stress tests. And I think that with more and more banks clamping down on financing and ultimately, you know, liquidity getting a little bit tighter, I think that creates a very interesting scenario. And quickly to touch on, someone was also asking, well, what about people re-upping their mortgages? This does not impact people that are going to re-up their mortgage if you stay with the same bank. So if you already have an existing mortgage with RBC and you're going to re-up for another 5 years, if you stay with them, you won't get stress tested. If you want to move to CIBC or TD, you then have to go through a stress test. So you're basically locked in at your bank unless you want to get stress tested. And so this obviously gives the big banks a little bit more leverage. Maybe they want to jack rates up on you, etc. That's just the reality of the situation. So yeah, I mean, I think in the short term, again, just sort of getting back to the whole market implications, I think in the short term, again, this gets implemented January 1st, 2018, but I believe they're actually supposed to start stress testing people immediately. That's what the report said anyways. Could this temporarily push condo prices up? I think it has the possibility to do so. I'm not going to go ahead and say it's going to. You know, I look at it again because, right, it's like if you have someone that can say afford previously could have bought a $500,000 condo because their mortgage is getting bumped down 20% to the stress test. Now you can afford $400,000. Does that push more people down the rung and into that like one-bedroom condo segment? Potentially. I think that's something we'll have to watch and see how the market reacts to it. Could this create a flurry of people that have, you know, rate locked for 120 days that are going to try to close on a property before they have to go through the stress test? I think we could see a little flurry of action here in sales, in volume in the next, you know, 3-4 months. I think we could certainly see that as people try to get in before they get stress tested. But I think that, again, when this policy gets implemented, there's always generally a lag. So I feel like you might not see the whole implications of it until maybe, you know, early to mid 2018. I think that's when you'll start to really get a really understanding of where this thing is, how it's all going to play out. And I just want to quickly touch on a few things. I'm going to try to wrap this video up, but the pre-sale market, impacts the pre-sale condo market significantly. So if you had bought a pre-sale 2 years ago, whatever, and you're going to go close on it, let's say this new condo building completes April 2018. You are going to have to go through a stress test. So you might have when you bought this thing 2 years ago, you might have locked in, they might have said, hey, based on your income, a 5-year rate at 2.5%, we will loan you this amount to close on your condo. But on pre-sale condos, you have to get reapproved. You have to get reapproved upon closing, and you're gonna have to get stress tested if your thing gets completed into 2018. And so this is the big thing. Everybody thinks these pre-sale condos are risk-free, and I've been talking about this for several videos now. Your average person, a lot of the times, is they go into these pre-sale centers and they don't have a realtor. They just buy it directly off the developer. They go in, they look at the floor plan, they go, wow, look how shiny this new kitchen is. I want it. And they have no representation. They don't understand any of the risks. And this is what happens. And I'm going to harp on this because I think people don't understand, especially buying it at today's prices. Okay? At today's prices, I know all these projects. I know the values of them. For the most part, on your typical project, you're paying a 20 to 30% premium for a pre-sale condo, and that's not going to be completed for about another 2 years, let's say. So you're paying a 20 to 30% premium to lock in a price for in 2 years when you don't know what the lending conditions are going to be, and you don't know what prices are going to be. So this is a prime example where you're now subject to OSFI. The government can change the rules any day they want. And, you know, they can come out tomorrow and they can say, no, we're banning assignments. We don't care. Now you're stuck. And so this is what OSFI did, right? Like who would have thought a year ago that OSFI would, or 2 years ago when you bought it, that OSFI would come in and bring a stress test and reduce your borrowing capacity by 20%. But you should have certainly known that we are at all-time low interest rates and they were primed to go up. And you should have known or been at least aware that, hey, you know, what happens potentially. So again, basically, you're closing on a pre-sale project in 2018. Prepare to be stress tested. I think there's going to be people, some people are going to get jammed up and they're going to need to basically assign these contracts, get out of them because they're not going to be able to come up with the money. Some of them will have to go to alternative lenders. Let's hope there's money out there. You're going to have to pay the premium. You might have to pay, you know, upwards of 10, 12% to get that initial temporary loan. But there are going to be some people that are going to have to basically assign these projects. You know, you might have done very well on it because the market's gone up again, you know, 60%, you know, 25, 30% a year for the last 2 years. But again, if you're buying into today's pre-sale condo, just understand the risks involved. And I have people, especially first-time buyers, call me all the time and ask me, oh, like, can you help me out with a pre-sale project? What do you think? And this is the problem, is they don't understand the risks. You're locking in today at a 30% premium. So if the market doesn't go up by, you know, 30%, now you basically have overpaid. But let's just say you buy into a 30% premium. Let's say the market flatlines, or let's just say, oh my gosh, it goes down, the market drops 5 or 10%. Well, now what? The banks might say, we're not gonna loan you the full amount. Let's just say interest rates today are at 3.2. Let's just say they go up to 4.2. Now you know your mortgage capacity is coming down. So again, these are the risks that you need to understand. Is not only are you paying an obscene premium to buy this, to lock in a price, you don't know the quality of the construction, and now people like OSFI can come in and bring stress tests. You're at record low interest rates. They really have, I would say, they don't have anywhere to go but up. I mean, gosh, I don't know. I mean, anyways, I'm not going to ramble on too much, but that's sort of the implications. I think that's going to be a very interesting space to watch over the next 6 months to 1 year, seeing how this pre-sale market really shapes up. Are we going to see a flood of assignments with the stress test? Are we going to see low end condo prices shoot up here in the next short little window? Are we going to see a lot of volume before that stress test as people try to basically run to get in before getting stress tested? Are we going to see a push to more alternative lenders? How much money do they have to continue to loan out? How much appetite, how much capital do these credit unions really have to take on the more volume? Again, think about it as you're reducing the typical mortgage by 20%. So I look at you know, a single detached house for 1.5. I think that's an area that's going to be more impacted by the stress test. Definitely is you know, people are obviously at that price point are relying on mortgages, and when you're reducing that mortgage by 20%, substantial. So again, that's all I got. I don't want to ramble on too much more. I don't know where prices are going to go. I'm not going to make any crazy forecasting or prediction. I remain doubtful that by reducing the average mortgage size by 20 to 25%, that will cause prices to go up. I certainly think that it would slow the growth of prices at a minimum. And that's all I got. So anyways, check in back next week. Again, love to hear your comments in the description below. Chat soon.